Man, this OBS crap. Total frustration from this thing. OBS is what I use to, by the way, good morning. The software that I use to try to stream this crap to YouTube is not working with me today, so I'm trying to figure out if I can get the audio captured here. In a second. And audio check, audio check. Okay, now I can hear you. So anyway, good morning. Sorry for my delay here. It's technology for you. The NASDAQ here has had its high impact news driver release at 8:30, and then they've pumped it up into the new week opening gap at on July 28th, 2024. And we have a 15-second chart on the right, and then we have the 1-minute chart in the lower left. And upper left, we have the 15-minute time frame. So I'm a little jerked out of gear because of my actually not opening up like I wanted it to. So give me a few minutes to get my bearings here. No Navy term, my grandpa used to use my bearings. Let's peel through this with the 1-minute chart. This line here is the close and the opening basically being the same price at 5 p.m. yesterday evening, New York time, and 6 p.m.'s opening price. So if you recall yesterday, I was mentioning how if it was going to continue, it was going to trade up into a new opening gap here on July 28th. And if it continued higher than that, we had some daily short-term high and a volume imbalance that was further back in the year. This was pretty aggressive here. Opening on our high impact news driver at 8:30 and sending it up. And finally bumping that old new week opening gap on the 28th. right, so we had several highs in here swept into a old new week opening gap. And we'll be watching, does it want to use this information here with that gap and maybe use a wick into this one between this candle's low and this candle's high. Now, I was going to talk to you a few days, I think it was last week, I was going to talk to you about wicks. But I never got to it because the stream got interrupted with the remnants of Hurricane Debbie. So whenever there's a wick, I like to see it try to trade back down to the midpoint. If it doesn't get to the midpoint, it's like a fair value gap that can't trade to its consequent encouragement. So it's usually indicative that it wants to go the other direction. Because it didn't trade there, and we have done somewhat of a nice smooth area in here, this high, and then we ran up into the new week opening gap. I'm watching during the opening range, which is the 30 minutes after 9:30 to 10 o'clock. Do they want to send it up in here or into that? Because if there's two fair value gaps, this is the one you're watching, but you have to make an allowance for it to trade up into there. And if it does want to sell off, I want to see it try to trade down to here. I'm not trying to call the top. I'm not trying to pick the top. I'm not trying to force an opinion. I'm observing and seeing if it wants to provide that information to me. And the main focus today is turtle soup, by the way. I just want to get a read on what it's doing here going into the 10 o'clock hour. I hate to have to do all that kind of stuff. It gets on my nerves too, but all these people out there trying to beat me to get engagements for ad revenue or whatever it is they do. Let's do this. To the fellow that says, make the borders opaque, I want to see the borders. I want to see what the actual candlestick wicks are traded to. So if I don't use the borders, they won't really technically be accurate. So you're getting a chance to see what it's like when I'm jerked out of gear, because I was fighting with this OBS thing for like 20 minutes. It wasn't syncing with the microphone. It wasn't giving me any audio connection at all. I had to keep restarting the system. And I don't know, they had an update, and I chose to use the update. And I always tell myself not to do that. And it wasn't working, so it took several times to do it. Now I'm a little pissed off, to be honest with you. Because I come here later than I wanted to be. All right, so we swept down below the close and the opening price at 6 p.m. Since there's really no technical gap or difference between the two prices, I always just use a simple little line like that. Okay, and I treat it the same way. They can sweep through it, come back and revisit it. It's one single level. It's not a range or an inefficiency. It's just one single price level. So you see we had this candle here, trade to 131.50. High here, 131.25. 131 even. So just fell short of touching that gap there. I was talking about, I think it was yesterday or the previous session when I was referring to. Oh, that was yesterday. Yeah, it was yesterday when I was talking about the lowest barrier to entry. The easiest entry points are going to be the ones that you don't try to finesse too much. And if you're trying to use a one tick above to get any kind of short in that fair value gap there, you would have been filled. And that's the punishment for trying to be too perfect, trying to demand perfection, which is a good problem because most people can't even figure out what to do in terms of direction. They can't figure out how to get into a trade. So if you have a problem with not getting filled on some of your trades, or initially if you're trying to demand too much perfection, that's actually really good. It's a nice problem to have. It's so much better to tolerate a repeated phenomenon of you trying to do something that obviously is on the side. That means you're correct in where you think the market's going to go, versus not knowing what you're doing and always getting it wrong. So it's a little bit more palatable. It's easier to sleep at night knowing that you're on the right side generally. But I got people, sending me emails and reaching out to me through Telegram and reaching out to me through TradingView and reaching out to me through personal text messages, which is that annoys me. I told everybody I was going to change my phone number last year when I got to this year, and I haven't done it yet because I just haven't made my way to do it. But it's just too many people, they take it upon themselves. They feel like they can text me like we're best friends. And I generally don't like that unless I reached out to you or gave you permission. So we traded down to the consequent encroachment of the wick as we were looking for. The only difference, and the notable thing is we didn't trade up into the gap. We got real close to it within a tick's distance within the delivery of price. Okay, so I want you to screenshot that and make special notation in your journal how this is what we were watching. We wanted to see if you could trade up into it. It did not trade into it, but the idea of trading down to the consequent encroachment of that wick, it was the draw that we saw price reach for. And now I want to see, do we keep it? Do we have the ability to stay right there with the bodies? Or do we explore to the lower quadrant on that wick? Now, the wicks are going to be part of the conversation today when it comes to turtle soup, as you'll see. All right, so here's the opening price on that wick, all the way down. So we're looking at the actual news candle. So at 8:30, there's going to be a lot of inefficiencies in that individual candle, meaning that where we opened, it ran down aggressively real fast. And we'll look at that on a sub 1 minute chart in a few minutes. But for now, this inefficiency where price is here, and in a few moments, I watched it deliver this morning. It was wild. It wicked real fast, went down there and did not spend much time at all, and right back up into where we are here in the body, and did its business going into the close of that individual candle for 1 minute. Meaning that there is inefficiencies all through this range from the candles open to the low. And again, that'll make much more sense to you when I show you the less than 1 minute charts. So in other words, the 30-second chart, the 15-second, 5 and 1 second chart. But the first rule of engagement, whenever there's a wick, and if it's a swing high or a swing low that has my interest. Obviously, this is where the damage was done this morning. Anyone that was long going into the 8:30 news driver, the high impact news, and maybe we're holding on to the targets we were outlining yesterday, the new week opening gap on the July 28th. We mentioned that yesterday as a continuation. On the upside, should it reach for further higher prices, this is one of those levels it could reach for. But before it goes there, it trades aggressively, drops down over 100 handles or so, and then eventually pegs that level. This drop down is inefficient, but every single time there's a wick, and it's part of a swing high or a swing low that has any importance to me, technically, I'm interested in having the consequent encroachment level annotated, as you can see here. Now, I don't know where you're from. I don't know what school of thought you're predominantly a part of. I don't know if you're here because you just out of mere curiosity and you trade another methodology, or if you trade the stuff I teach. But that to me, and turning like that, is significant, and it tends to happen all the time. This is a 1 minute chart. So the question is when you see that, does it invite you to investigate more details around it? Because that's what it started to do with me in the 90s. I was looking at these things happening, and I'm like, okay, it's probably going to go down below that low. Well, sometimes it doesn't do that. So I was going back through charts and looking at different time frames, using Metastock was my software program back then, and I was using end of day data. So I didn't have real time data, but I could go down into intraday charts. It was part of an end of day package of data. So I would look at hourly charts and 15-minute charts, and it would give me like an x-ray view of what took place in the previous day. So I compared and contrasted what I was watching when I was driving around in a truck delivering candy, soda machine items, coffee machines, cold food machines. That was what I was doing at the time when I was learning how to trade in the 90s. So I fixed and repaired and serviced vending machines. And I had this little device called Quotrek. And if you've been around for a long time like me, you know exactly what I'm talking about, but it was kind of like a little radio. It's about the size of a transistor radio, not as thick, but it had a little extendable antenna. And it would give you data on any markets that you're subscribed to. You know, CBOT, Chicago Board of Trade, Chicago Mercantile Exchange, any of the grain markets that would be on CBOT. I'd be watching them. I'd watch the grain and the meat markets, and I would watch the currency futures. And eventually moved away from that and started watching predominantly the bonds and then the S&P. So it would give me the details that I would see these flashes in price action that would just be numeric. It doesn't give you a chart, or rather, it did not give you a chart. The technology really, I guess, wasn't there yet, so they just gave you the raw data, which was the highest high and the lowest low and where you're at in the volume. And I said this before, so it's kind of like redundant for folks who've been around long enough. That was what I was doing when I was away, where we have a smartphone today. So if I'm out and about, or if you're out and about and you're not in your trade room or office, you can see what the charts are showing and where the price has been and where it's probably going to reach for, because you can see it visually. So I was kind of handicapped initially. So when I saw big runs take off, I would write down, usually on a paper towel that I would use to wipe down the inside of my windshield or whatever. You should have saw this. It was wild. I was not organized in the beginning because my job and keeping my job was the most important thing, but I was still trying to manage all this stuff and watch it real time, the closest thing I can be tapped into this. And when I would see price runs start taking off, and I'd think, okay, it's occurring right now at 10:49, okay, or 9:36, and I'd write the time when I noticed it by the numeric run-in price. So in other words, when it started taking off, I didn't have any visual representation of that, except for I know I saw a price print numerically. I mean, in other words, it would say this price here, 19,048 in the quarter, and it would fluctuate as it's moving here. So if I see these runs, I make a notation or made a notation, and when I got home in the evening time, after working out, getting a shower, eating, and then the rest of the night, I'd be out in the charts constantly, pouring into it and trying to look for these types of things. What made that run like that? And I would see certain things, and sometimes, not all the time, sometimes there would be these long wicks. Now, this is exaggerated because it's a high-impact news driver. It goes without saying that PPI, CPI, FOMC, non-farm payroll, those types of reports or those types of data points that are released in the marketplace can create that formation of this type of move. When it creates this and it starts to rally up, I've never seen anybody, and I have over 2,000 books, I've never seen anybody make reference to anything about going back into the middle of this wick or break it up into quadrants and use it for the purposes for reversal patterns or short-term trading or anticipating it returning back to it for the sake of a target. Okay, so it was exciting for me to see it. And as you watch this one pan out here, from here to here, that was the observation. So Caleb, when you see this, I want you to annotate how it did not trade up into the opportunity for you to get filled, but it still ran. And then I want to see what your description of that run is in your own terms. I don't want to say anything more, but I want to kind of correct it if it's not what I think is appropriate. And if it's right, or if it's in the right perspective, then obviously I'll commend you for it. But the market trades back up. What's it trade back up? Remember I told you what this line was? If you missed it, if you came to the stream later, you just signed into it. Yesterday at 5 p.m. when we closed the settlement price, and then when we opened up at 6 p.m., there's no difference in between those two prices. So there's no gap. So all I do is annotate that price because it'll still refer to it. And as you can see, we trade back up in. What is it trading into also? What other confluence is there? Look close. There's two other things there. You have that gap, and then you have what I'm discussing here. Whenever you have wicks, you want to measure that. Okay? Here's the halfway point or consequent encouragement. This wick is allowed to go through it. Why? Because you have a fair value gap. But then look at this one here. What's the high of that? You're going to look right over here. Look up in the upper left-hand corner. What's the high of that candle right there? 19,096.50. That's exactly the consequent encouragement level of that wick. You're going to tell me that that's buying and selling pressure? Yeah. So when you're looking for entry patterns, when you're looking for targets for limiting out on partials or terminus, here's your 3/4 level, trade it to. Now, because of this, I want to see it respect this up close candle. In other words, don't trade above it. It can come back and touch it again. It's better if it doesn't, it leaves a little portion here. But I want to see it to explore now below this 830 news driver. That's what I like to see. But here, this wick trades up to cutting through candles because it's not supply and demand. We go right back to this wick right here. That candle's high to the tick gives us the actual high that you can anticipate as it's returning back into here. Why should that be reasonable? Two things. Number one, you have this wick here. Bear with me. I have to put the lipstick on this chart to show you what I want to see illustrated. When I was working on this information, figuring it all out, codifying everything, and discovering a lot of things that really wasn't in my books. No. just draw a line there? It's disappearing. Oh, I know what I did. I have the color. All right, so that's going to go on that candle there. And it needs to go to the 50 level. 96.50. 96.50. All right, so now I can take that off, and you can see that that's anchored to here. So this is what you want to be doing, Caleb. You don't want to be leaving your Fibonacci's on top of the wicks because it'll clutter up your chart and it'll make you angry. And it's also, you just don't want to have all that information on there. So it's not important to have all that. Let me put this down here. Some people are like, I'm trying to put my stuff on their social medias and pretend that they're me. So we have this wick here. We have this gap. It trades up to there. And also, what's to the left of this candle? The one that trades into the fair value gap, right? So isn't there a wick on this candle? Sure it is. So we have this wick on this candle inside of this fair value gap and this wick here. So when price was trading off of this target we were looking for and it rebounded off that, came back up into the fair value gap, it's reasonable for it to go up to the fair value gap high, which is this candle's low. This price right there on that wick, it's a premium array because you're trading back up to it. You extend that through, it's part of the fair value gap, and then the next candle trades up and touches it. We do not want to see, this is important, we do not want to see, if it's going to be bearish, we don't want to see that consequent correction of that wick. Once it's traded to here, once it trades back up to it there, we have this fair value gap that should send price lower or kind of keep it at bay, not trading it higher. So if this candle is trading back up to it, we are trusting the logic around this phenomenon saying that it's already done the work of trading to the high of the fair value gap. So half of the fair value gap, let's look at that. You can see it in here. It doesn't trade there. Notice that on this candle? It does not trade there. Is that a good thing or is that a bad thing? Think about what I've taught you. In this mentorship, I taught you that PD arrays, very specific levels that we're looking for, if they fail to be printed to, if they can't even return back to them, and you have a directional bias in concert with that level you're studying, if it can't go there, that means it's decidedly weak. And when you're bearish, that's a signature you want to see. But because we have this area over here, and because I'm not trading support and resistance, the support and resistance fellows would have been like, okay, here's where we stopped. So let's draw that line out in time. Well, we went way past that to some random up closed candle and created a wick, something random. We don't know why it went there, right? Support and resistance folks don't have any idea why it did that, but you're learning it. It's this wick here. It trades up to it, completes and fulfills the role of buy-side delivery, which was inefficient on this candle. So the market has offered single pass to the downside. So this is sell-side delivery. That means price is going lower. Then it comes back up to re-deliver the inefficiency in this time of that one candle. What was it inefficient on? Delivery to the upside. So buy-side delivery. It offers it, stops to the tick, and then drops down. The next candle, if you're looking for support, if you're looking for swing highs and swing lows, you want to see it trade up into levels like this. It should hit that and stop. And also fail to trade to half of that fair value gap. That's a failure to get to consequent encouragement. We've already fulfilled 3 factors here. We traded up to finish in filling out this candle's low to the difference of this candle's high, which is that fair value gap right there. That's a SIBI, sell side imbalance, buy side inefficiency. We trade back to the 6 p.m. opening price. Why is that important? Because there's no gap between Friday, the 5 p.m. close settlement price and where we started trading for NQ. So because there's no gap, we just simply use the 6 p.m. opening price. I told you when we were up here, you're going to have it on your chart because it's going to be treated the same way. It'll trade through it and come back and treat it as a key level. It trades through it on a wick, which is reasonable because we're inside this fair value gap. But this level here, when we trade it back up to it, notice that the bodies in the candles do not trade and close above that wick. Consequent encouragement. See that? It's telling you that this candle backed off. So that means when I see something like that, I'm looking for the immediate next candle to do a lower high than this high. And I can frame everything on that fair value gap and where that consequent encouragement is on that wick, if it's there. You may not have a wick over here. Then you would just simply go into the details of simply using the 6 p.m. opening price, which is this dashed line, and the consequent encroachment of that fair value gap. So in other words, if this wasn't here, I would expect this to trade up to midpoint of the fair value gap. But if it doesn't and it trades down lower, I'll simply just go in short on the open and touching back this body right here, as it does there. So, and that could be easily done on a 15-second chart, a 30-second chart, a 5-second chart. You would see a little bit more detail in that difference between where we close on this 1 minute candle to where we open there. And I know some of you, because you're leaving comments saying that you don't have the ability to afford the real-time data. I got to be honest with you, at some degree, you're going to have to do that. If you're going to trade, you have to have the information. And I don't know how to say it any nicer than if you can't afford data and watching real-time price action, a lot of the things I'm teaching are going to just simply be outside your grasp, and you're going to have to use a hard time frame premise. And there's nothing wrong with that. It just means that you're going to have to defer these very small intraday price action moves. But all the things I'm teaching here, this could simply just be a daily chart. In other words, instead of 1 minute candlesticks and this representing the highest high, the lowest low, and where it started and ended trading for that 1 minute interval, these could represent a daily high, low, and open and close for the day. It's the same stuff. Don't think it only works on 1 minute charts or intraday charts. That's not it. These levels will be referred to on any and every time frame. If I was watching price over NQ and we had the time frame set to 4-hour chart, price right now at 41.75 is the same price you'd see it on a 4-hour chart. Price is price. But if you're looking for details, for precision, you want to look for very sensitive timing so it gets you into a trade and or reduce the measure of risk. You're always going to have risk, but you can reduce the risk and manage it appropriately by having intraday charts, because you can see details in price action that otherwise you're not aware of. Okay, and that's kind of like why I was tapping into the memory of how it was for me when I was driving around in a Isuzu cargo truck, delivering cane, soda, cakes, and chips, and coffee products, and cold food, and ice creams. I was looking at just simply data, and I had to later on go back in and remember my notations as I was driving. Sometimes I missed it, and I had to figure out, okay, well, I was in traffic. I'm trying to get around this guy or get around that part of town, and I couldn't look at the data, even though it's right in front of me, duct taped on my windshield. So it was like a hillbilly version of a ICT, right? I mean, you're all impressed with the NASA spread out of all my monitors and stuff I shared on YouTube. But back then, I didn't start like that. I had literally like this little transistor radio type thing physically duct taped to make sure it stayed in my view and it wouldn't fall and break. But I had to take the notations and say, okay, I don't know when it started taking that run because I wasn't watching it. I'm driving still, which isn't safe. I'm not recommending this at all for anybody. But I was the original, driver being distracted by a cell phone, because that was like the equivalent of a smartphone today back then. So I was more interested riding over the Key Bridge, watching those numbers than watching anything else. And look at the response rate off of that level there. See that? Isn't that nice? Just that alone, that one single pass like this, That was enough to draw my interest into seeing what's going on there. Is it repeating? And I'd go through data and I'd see it again and again and again and again. And it caused an obsessive compulsive desire to figure out what was repeating there. And then when I'd go back through price action, I would see all these little details. Okay, and say, okay, this is what's occurring at this time. This is what's occurring at this time on that day. And then if we had a big news driver, which I didn't understand too much initially when I first started trading, like I didn't care or even worry about an account counter. So when I was in there trying to trade, if there was ever a grain report that came out, or if I was trading crude oil and I didn't look at the inventory numbers that come out, like around 10:30, New York local time, in the market would create these moves, and I'd be like, whoa, where the hell did that come from? Because I didn't have any understanding about an economic calendar. So I started way too soon with money, and I didn't know what I was doing. And back then, I was like a cowboy. I just gunslinging. It's all I wanted to do is be a part of it. Thinking, which is what I have taught against now, because I did that stuff. I tried to learn how to do it with real money, and it caused all kinds of problems, and it slowed my growth. But when we're looking for these wicks, okay, wicks are going to give you so much more detail if you are using them in the proper context. Okay, so I'm watching this as I'm talking. I'm looking at this little gap in here. Does it overtake it, come back down, treat it as support, or is it respect it and then roll over and take out the relative equal lows it's formed here and then explore the lows at 8:30? But if I'm looking for turns, okay, when I learned about swing highs and swing lows, we learned them as ring highs and ring lows. Okay, we didn't call them swing highs and swing lows, and the reason why is because you would simply print your charts out, or not print them out, but you would literally draw them out. So back when I was learning how to trade, we had a service called Price Charts, and they would mail you one set of price charts for the week, and then you would take the opening price, the high, the low, and the close, and you would draw them physically on the chart because it would give you room. That's the way I learned how to do this stuff. And you have no idea the advantages of what you're learning and how fast you're learning it, because 99% of you would have never stuck with it if it was like that. And to think of it and being described like that, you're probably thinking there's no way. But everybody that's 30 years or more in trading, that's the way it was. Like that's the way it was. I mean, people, I watched my generation, we watched things become computerized. I watched electronic trading. I was part of that last generation of old school OGs where price charting was done by hand, every individual candle. And the only thing you did that with was on a daily chart. See that little run right there? Right after that fair value gap, trades up into it, plummets, and the interest is below that low. So if it does this, we're going to see we're going to see a big candle like that expand lower. So isn't it fun watching somebody knows what they're talking about in an interesting, instead of staring at the chart not knowing what it's going to do? But I'm also giving all kinds of information that are just gold, because this information, if you look for swing highs and swing lows, which is what we called a ring high and ring low, because, for instance, like this little candlestick high, it has a lower high to the left of it here, a high that's lower to the right of it than that one. So in other words, we have a candle that has a high that has a lower high to the left and a lower high to the right. So we call that a swing high. But on my chart, if this was a daily chart, I would put a little circle or a ring right above that. So that way, when I looked at my charts, I could map out market structure. I could see where we are in deference to previous swing highs and swing lows. And if I start seeing swing highs that are forming that are lower than a cluster of swing highs further back, then I know I'm probably part of an intermediate term price run, which is kind of like what I was hinting at here. We're going all this business here. We talked about it trading down to the midpoint when it was here. We were focusing there, but because we're looking for too much of a precision element, here's where you would have failed using an entry. You would not have been filled, but the market runs with you. Okay, if you couldn't get in there, then you can use this. You see that? Okay, say you couldn't get in here, but then you have the market come back up and trade into this candlestick here. We don't want to see it trade above that candle. There was a gap here, but it trades all the way back up, but it does not take out the high. See that? Trades right back to what? Consequent encroachment, that wick I talked about at 8:30. This could be your entry. This could be your entry. Let me test your memory and see if you kept good notes. What is this candlestick providing you in terms of an entry mechanism? I talked about it yesterday. I talked about it a lot if you've been my student for a while. But this candle right here, what is this candle when it traded there like that? What is that referred to? I'll give you a second while I take a sip of my water. Institutional order flow entry drill. Very, very, very long-winded name, okay? And you're probably saying, why did you name it that? When I teach students how to trade inefficiencies in price action and fair value gaps, when you have a price run, okay, once it enters a significant and obvious sell-side program or sell program, and it's sell-side delivery, that means the market's simply just moving lower, okay? There's characteristics, there's identifications that I use, and sometimes when I'll say those, you'll hear me say, okay, sell-side delivery. You're thinking sell-side liquidity or sell stops. That's not what this is. Sell-side delivery is a sell program where the market is going through the motions of delivering lower prices, and it doesn't matter how many people's buying. It doesn't matter how many people are selling. It's just algorithmically spooling in a direction, and if it's sell-side delivery, it's going lower for the express purposes of delivering lower prices, and it matters not how much buying and selling pressure is there, okay? But when I teach and when I taught students using these inefficiencies, we outlined when we were up here that we first want to see a trade there, and then we talked about all the business in here, and then we talked about going, next target was the lower quadrant, which is there. This is not Quarters theories, by the way. Quarters theories is a bunch of bullshit. So I'm going to say it and stop asking in the comment section. I'm sure there's some very nice people out there and they have their faith-based ideas around it, but it's absolute horseshit. So just know that that's my opinion. Please stop asking me about it. The low is the next target. Why? Because there's the liquidity resting below it. So that's sell-side liquidity. The motion from here to here, that run right there, that's sell-side delivery. This high down to this lower quadrant is sell-side delivery. It's delivering lower prices. And then the up close candle, I said we didn't want to see it go above that. In case you're wondering, here's the high. Did we trade above it? No. Okay, so having order block theory, having fair value gap theory, having market structure theory, having institutional order flow theory, real institutional order flow. Do you see any depth of market over here? Do you see any horizontal volume things that make it look like I'm technically advanced? No, you don't need that. All you need to know is where's the mark, okay? Who in the room is the mark? Who's the victim? Because if you can determine who the victim is in the room, you know who's about to fall. Who's going to get something they ain't wanting, okay? If you can't identify the victim in the room and something's about to go down, you're the mark. The same thing happens in the marketplace. If you can't determine the liquidity that's about to be absorbed, engaged, taken out, you're the liquidity. You're going to be used as the cannon fodder for someone else's trade like mine. Okay? So this is sell-side liquidity, yeah, but the way my son needs to start looking at these runs, from seeing this to this target, there has to be something measurable. Well, that clearly is, it's measurable.